Assalamualaikum Muhammad Fazli. My metric number is A24A3346. I will start with your introduction. Pokong founded in 1976 and listed on Bursa Malaysia in 2004. Operates around 100 stores, making it the largest gold retailer in Malaysia. Its large-scale and in-house manufacturing help control costs and support stable, diversified revenue through multiple brands and gold-related services. Tome founded in 1968 and listed on Bursa Malaysia in 2006, operates about 60 stores and focuses more on high-value jewellery and bridal collections. Through vertical integration, Tome improve production efficiency and target higher margin market segment. Overall, Pokong emphasizes scale and revenue stability, while Tome focuses on efficiency and profitability, making both suitable for financial comparison.
Assalamualaikum. My name is Nur Najiha Ansha. My metric number A24A3465. Starting with Pokong Holding Berhad, this company focus on trading and retail of gold, diamond and precious metal. They offer jewellery, investment gold and service like gold buyback and investment advice. Their main customer are individuals, families, entrepreneur and investor. Pokong reach them through physical store in strategic location and digital platform like e-commerce and social media. Their business strategy focus on customer-friendly promotion, satisfaction and loyalty. In contrast, Tome Consolidated Berhad operate as a manufacturer, wholesale and retailer of jewellery. They offer a variety of product from gold and platinum to diamond and gemstone in both traditional and modern style. Their customers include daily jewellery users, couple getting married, high net worth individual and investor. Tome sell through physical store in Malaysia and export internationally using both B2B and B2B channel. Their strategy focus on product diversification, rebranding with collection like Lee Lumiere and Gold Heart, and managing all processes internally to maintain quality.
Today, I will present the horizontal analysis of Pokong Berhad covering 2022 to 2024, focusing on liquidity, profitability, efficiency and leverage. In terms of liquidity, the current ratio declined from 4.83 in 2022 to 3.30 in 2024, indicating slightly weaker liquidity, so the company can still meet its short-term obligation. The quick ratio remained low, showing reliance on inventory rather than cash or equivalents. Profitability improved significantly in 2024. Gross profit margin increased from 19.64% to 21.79%, while operating and net profit margin rebounded. Returns on asset and equity also peaked, reflecting better cost control and effective use of resources. Efficiency-wise, inventory turnover dipped after 2022 but slightly recovered in 2024. Total and fixed asset turnover improved, suggesting the company became more effective in generating sales from its asset. Regarding leverage, Pokong maintained a conservative structure. Debt ratio fell to 0.20, while times interest earned improved, showing strong ability to cover interest payments with low financial risk. In conclusion, despite some weakening in liquidity, Pokong demonstrated strong recovery in profitability, efficiency and financial stability, reflecting improved operational performance and prudent financial management.
My name is Amalin, and I will present the financial ratio analysis of Tome from 2022 to 2024. In terms of liquidity, Tome shows a strong position. The current ratio increased from 2.76 in 2022 to 3.11 in 2024, indicating that the company can comfortably meet its short-term obligation. However, the quick ratio remains below 1.0, showing that Tome still depends on inventory for short-term payments. Next, profitability was strongest in 2022, although the gross profit margin remains stable. Both operating and net profit margins declined in 2023 due to higher costs, with only slight improvement in 2024. For efficiency, Tommy experienced a decline in inventory and asset turnover, suggesting reduced efficiency in converting assets into sales. Lastly, Tommy's leverage increased with a higher reliance on debt compared to 2022, which raises financial risk. In conclusion, Tommy has strong liquidity but needs to improve efficiency and manage its rising debt levels.
Next, I will presenting the vertical analysis of Pokong Holding Berhad. Based on the article, starting with liquidity, Pokong maintains a strong current ratio even though it shows a downward trend over the year. This means the company is still financially capable of meeting its short-term obligation. However, the quick ratio remains low, indicating that Pokong relies heavily on inventory rather than liquid asset like cash to settle short-term liabilities. Moving on to profitability, Pokong shows a steady improvement in gross profit margin, which reflect better cost management and pricing strategies. Although both the company and net profit margin declined in 2023, they improved significantly in 2024. This suggests that the company managed to control its costs more effectively and improve its operational performance. In terms of efficiency, Pokong record a moderate but stable inventory turnover, which is expected in the jewellery industry due to the high value of inventory. In addition, the total asset turnover and fixed asset turnover increased in 2024, showing that the company is using its asset more efficiently to generate sales. Lastly, from the leverage perspective, Pokong has a low level of debt and a high equity ratio. This indicates that the company relies more on equity financing than debt, resulting in lower financial risk and a strong financial position. In conclusion, the vertical analysis shows that Pokong Holding Berhad is financially stable, profitable and well managed with a conservative capital structure.
Assalamualaikum. My name is Noor Al-Fatiha. My matric number is A24A3378. I will continue representing about efficiency ratio and leverage ratio for Pokong and Tommy. First as all, let's look at the efficiency ratio. For inventory turnover, Pokong perform better because their inventory move faster. This shows that Pokong has more efficient stock management and is able to sell their product quickly, reducing the risk of holding excess inventory. Next, total asset turnover. Pokong is also better than Tommy. That means Pokong use asset more effectively to generate sales compared to Tommy. In other words, every ringgit invested in asset produce higher revenue for Pokong. However, when we look at the fixed asset turnover, Tommy perform better than Pokong. This indicates that Tommy used its fixed assets such as property, plant and equipment more efficient to generate sales compared to Pokong. Now, moving on to the leverage ratio. For the debt ratio, Pokong is better because it has a lower level of debt. This indicates lower financial risk, as the company relies less on borrowing funds. Similarly, the debt to equity ratio also Pokong. They show that Pokong relies more on equity than debt to finance its operations, which makes the company financially more stable. Next, for times interest earned, Pokong again perform better. That means Pokong is more capable of covering spend from its operating income, reduce the risk of default on interest payments. The equity ratio shows that Pokong is better because a large portion of its assets is financed by equity. This further support that Pokong has a stronger and safer capital structure. In conclusion, Pokong shows stronger performance in most efficient and large ratio, especially in managing inventory, using asset, and maintaining lower financial risk. Meanwhile, Tommy stands out in fixed asset efficiency. Overall, Pokong appears more financially stable, while Tommy shows strength in specific operation area.
Good morning and Assalamualaikum. My name is Nur Shahira binti Saleh. My number matrix A24 and 3269. In this presentation, I will summarize the recommendation based on the financial analysis of Hong Kong Holdings Berhad and Tommy Consmith, dated Berhad from 2022 to 2020. Overall, the analysis shows that Hong Kong is financially stronger and more stable compared to Tommy. Hong Kong records improving profitability, better asset efficiency, and low financial risk. Therefore, Hong Kong is recommended to maintain effective cost control, continue efficient operations, and strengthen cash and receivables management to sustain its strong performance. Meanwhile, Tommy shows several weaknesses, especially in profitability, asset efficiency, and leverage. Although its liquidity is improving, the quick ratio remains low and the company is increasingly dependent on debt. Therefore, Tommy is recommended to improve inventory management, reduce operating costs, strengthen marketing strategies to increase sales, and control debt levels to reduce financial risk. In conclusion, Hong Kong is in a stronger financial position, while Tommy needs to focus on improving efficiency, profitability, and leverage management to ensure long-term financial sustainability.
For sources of fund, Pokong Holding Berhad is in a very strong financial position with high liquidity, low debt levels, and a high ability to cover interest expenses. Therefore, the most suitable sources of fund for Pokong is debt financing, such as bank loans and bonds. This allows the company to finance expansion like opening new outlet, automation, and international growth without diluting ownership. In addition, listing is suitable for acquiring machinery as it improves cash flow flexibility. Overall, debt financing enables Pokong to grow while maintaining control and minimizing financial costs. Next, Tommy Consolidated Berhad has higher financial leverage with rising debt to equity ratio and declining interest coverage. Due to this higher risk position, equity financing is more suitable for Tommy. Issuing shares through right issue or private placement can strengthen the company's capital structure and reduce reliance on debt. Additionally, joint venture and strategic partnership allow Tommy to share risk and costs when expanding into new market. In conclusion, Pokong is better suited to debt-based financing, while Tommy should focus on equity financing and partnership to ensure sustainability expansion.